You pulled this out of the archives, basically. Just maybe explain to me and to the audience here the Brady plan, and kind of what you were seeing that kind of made you think about this straight out the
Okay.
gates.
So old newspaper clippings here. This is from a development 40 years ago from involving the last major Latin American debt crisis, which was addressed through the U.S. Treasury Secretary Nicholas's Brady plan, is what it was called, or Brady bonds. And I'll get into what that means. But basically, what happened, right? Everybody knows we had the oil shock of the 1970s, the inflation and the dollar. We break that thing. Volcker hikes rates to basically give the body a fever, right? So we sweat out the inflation, hike interest rates to 20. We reset, U.S. debt to GDP back down to like the lowest levels they've been in post World War II, and from there, that created the backdrop from basically like 1982 onward, where we just expand this offshore dollar pie because we broke the link of the metals tie, or peg to the dollar, silver domestically, gold for international capital transfers, and we went purely to an IOU, liability dollar standard. All right, what that did in the rest of the developing world. So bottom right, you see oil prices, right, per barrel index to 2013 constant price levels. After that 1970s run up, beginning on the left hand side of the chart, you saw oil markets collapse, right, as this dollar system transferred from the asset backed dollar we talked about, based on the precious metals peg dollar. What that did is it put the developing world into, like, debt crises, right? I guess there's no other way to put it. And so what you had is all of these commercial banking systems. Like, I'm going to specifically focus on Mexico. Uh, you had a lot of bad dollar denominated debt, that the banking system, mostly in Mexico, but it also crossed borders. Like, there were some U.S. banks who had exposure to these loans as well, and you could say broader Latin America. Um, the recipe for getting those out, or getting out of that debt situation, that debt overhang, was developed by U.S. Treasury Secretary Brady. And in a roundabout way, what they found a way to do was make these bad loans in dollar denominated terms, turn them into good loans by with reserves, right, from say Mexico or another Latin American country, or getting them to buy zero coupon 30-year US Treasury debt that was custodied in New York. And then what they did is basically a transformation, like a three-card Monte scheme, to turn those bad commercial loans into high quality liquid sovereign denominated debt that then could into the banking systems and recover their balance sheets back to health. And what this actually represented, in my mind, is incorporating the Western Hemisphere developing markets into the offshore, Eurodollar order, is what this actually represented. Now, notice the security here. The collateralization was these 30-year zero coupon U.S. Treasury bonds that were, specially created by these entities like IMF, World Bank, et cetera, to make this structure work. Notice the 30-year clock. This system was basically 1990s era. Roll the tape forward 30 years. This whole patchwork scheme is coming to its end, and what we're seeing here, activity, and we can talk about sovereign debt markets. We'll get into that, but specifically in Mexico, what I view this as is like we're at the transition, one end of the bookend. This thing started in the 90s, 2020s. We're here on the other end of that wave, and it's now time for, say, Latin America developing market debt specifically. But I think front and center, what we're seeing here in market signals is telling us Mexico is, and we've opened up that theater for their integration, make or break into the new stablecoin dollar order, or find some other competing alternative. I guess we'll leave it at that, because it's going to take another alternative, and right now I don't see what it is. It's just more of the legacy kind of system, the old offshore dollar trying to resist at this point, more so
Sure.
than having an actual challenger. All right. So key things here in sovereign debt land: focus on the plots on that column where I have the circled yields I want to focus on. But the two who are standing out at 52-week highs, or sorry, this is 3 month, but you could say, like, if you just extrapolate this to the 1 year look back, you'll see a very similar pattern. Mexico's dollar denominated bonds are showing, high end of their yields. Same thing with Japan. So everybody is broadly following, like, there's plenty of attention on the Japanese yen and JGBs, et cetera. That's well covered. It is a story. It is part of this, and you could even say it's the catalyst. But what you're probably not hearing a lot about is the Mexico dollar denominated situation. And the last one, I'm not going to dive too deep into this, but you see the rails on EMEA, or you could call this the Eurozone area sovereign debt. Look at those two rails with the yellow lines. All of those blue dots where the country specific yields are lined up nicely. One of these things is not like the other. France, to call that out. It's the nail sticking out that probably gets the hammer. That's not a story for this week, though. Just continue to watch that, though. The French government situation is telling you, versus its peer group, something is probably in store for that, if you had to bet on it. But I want to focus today on Mexico, the US dollar bond. Notice, though, this isn't just an all Latin America dollar denominated debt problem. Why do we say that? Well, we got two peers right here. You got Argentina, where spreads on their dollar bonds have been coming in, right? It's the opposite direction of what you're seeing with Mexico's. And then Brazil's dollar denominated debt, roughly in line, almost the same yields as Mexico right now. They're within 2 bips of each other. They're at the midpoint of their range. Nothing too big going on at this point. Although you do have one of the most important elections of the year in my framework, with their presidential election coming up in, I think it's September, with Lula on the ballot. Um, Probably the second biggest election for the rest of the second half of the year, with the US midterms being number one, obviously. All right. So, Cameron, if you go next, you can see here, this is just the chart of the Mexico's 10-year dollar denominated yield. So I want to point out, if you look back on the 1 year, it's like, yes, these are um, moving up in terms of higher yields, but you can see that a resistance here at about 6.75%, that ever since we got into this transition, steering the dollar away from the offshore dollar system and then towards this stable coin dollar emergent long-term time horizon, right? This is going to play out not just in, you know, a few years. Like, spread this out. This transition is something, you can expect it to take the better part of a decade. Really be prepared for that type of horizon. But you can see there's, if you look at the pressure that this underlying phenomenon of higher U.S. Treasury yields is, well, the last uh, couple of months we've seen um, a strong dollar environment. If you just look at the DXY chart, I don't have it here, but all of this together is pressuring Mexico's sovereign debt yields up, and this is just part of the broader backdrop that we're talking about here as we get into these big developments that have happened in the last 2 months, but went almost totally uncovered in the broader financial discussion. So something that went over the head of a lot of commentators, most podcasts, if you're trying to stay informed here. Big development happened in May, late May. Moody's and Standard and Poor's cut Mexico's sovereign, like, triple B down to a triple B minus, right? Um, that Moody's notes is, at this point, stable after this this latest downgrade. But I want to note here, this is a triple B minus, or in Moody's terms, it's a Baa3, same thing. But it's that last rung where your credit rating is still investment grade and you have access to the investment grade dollar credit markets. Now, investment grade dollar credit markets are massive in comparison to the capital pool that you have available to you as a junk bond or high yield issuer or non-investment grade issuer. So if you lose access to the investment grade markets, you lose like your available pool to tap into for liquidity, it drops a ton. So if you're Mexico, you're kind of like it is very important to you to hang on to that last rating from here. All right. Mexico, like specifically in the Moody's report, they noted there's sustained weakening in the fiscal strength that accelerated in 2024 is where they first noted it, and that weakening is expected to persist. So, what is that weakening? It's reflecting that big transition in, you could say, the dollar itself that we talk about, also the pull in yields from the US's own sovereign debt situation. And then it's also, to a large degree, trade in those interactions with the US and Mexico representing the largest bilateral country trading pair in nominal terms. So, side development, we won't get into this week, but in the last day or two, President Trump allowed the USMCA to relapse. So basically, it turns into now, instead of a long term trade deal, it's up for annual renegotiations at this point. All right. So what this kind of broadly reflects, everything going on here. We talked about the credit rating falling, the underlying deterioration in fiscal strength. This is part of that process where Mexico now is kind of like we said, they're at that end point of that temporary stability that the Brady plan kind of offered them as one of the largest Latin American economies, right, in this old offshore dollar framework. They're now at that fork in the road, same process as kind of the US went through, as we describe it in 2022, choosing one direction or the other in the United States. I think Mexico now is at is at a similar fork in the road where they're going to have to make that choice. Ultimately, because this is the largest bilateral trade pair in the world, if the US goes one way, it is going to be almost impossible for me to see a world where Mexico isn't coming along with it. But if you look back on the broader 300 plus years of interaction between the American colonies and what it's grown into the United States and its interaction with Mexico, you could say the same thing with Canada or British North America, right? Um, you can try to go against what the United States wants to do, but ultimately you're going to be economically a lot better off as, Mexico in a sovereign sense. Like if you're playing for the home team, you're much better off going with the United States in my view. All right. So yeah, just to sum it up, we're at where the Brady plan's kind of duct tape and baling wire solution needs to find um, a new path for Mexico's own sovereign debt situation. All right. So what we've seen come up in the short term to address hiccups that are likely incoming, we just saw Mexico's central bank, the Banxico, add a bond buying toolkit to use as a backstop to its own debt and money market situation as we work towards this bottom that's coming in the short term credit cycle. So think of this tool like, what would this be? It's an emergency liquidity tool from the central bank to address, like, let's say, a repo rumble type of event, like the U.S. experience in its own money markets in 2019. For that situation, if and when Mexico's money markets veer off the rails. Now, keep in mind, you can provide all the emergency in Mexican peso terms, but to do it in US dollar terms, that's when you're attached to the bigger, fish in the sea, which is the United States and what it's doing, pulling control of the US dollar back towards, its own, domestic onshore economy, um, and away in the center of gravity away from offshore London, etc. All right. So I got two rates here. The blue chart, the shaded one, that's Banxico's short-term overnight borrowing rate in Mexican peso terms, and then the yellow is their 10-year yield in local currency. But you can really see here as the credit cycle bottoms, um, what happens? Well, those cuts that are in interest rates start to diminish, right? And that ability to keep lowering and lowering rates, eventually that runs out of steam. Once rates want to start rising, or overnight rates, all of that, they bottom out. The central bank runs out of capacity, and the economy, the financial system, run out of capacity to keep credit expansion going. All of that stuff to ease in the money market, uh, interest rate cycle, all of that. What happens is you bottom out, and then once that's over, local currency borrowing costs tend to rise, and that's where we're talking about that those same things we were highlighting in the Moody's report about the worsening fiscal position. It just them worse, right? So that's where you're looking to things like the framework for the United States being in a pickle. Nothing stops this train. We're going to QE, etc. If you actually look to the other players across, like sitting around the table, it looks to me like this cycle, like the U.S. Reasserting its control and dominance over its U.S. dollar. It's actually passing the buck on to the other players at the table and forcing them to react. So this is kind of part of the bigger picture that we've seen in the Western Hemisphere in at an accelerating rate, right? This is just adding financial pressure in the capital markets arena onto the bigger power struggle developments we've seen taking place in countries like Venezuela, Argentina, coming soon to Cuba, Mexico, et cetera. And you've already seen the military and financial sanctions in Mexico with the targeting of cartels, um, which ultimately bubbles all the way up to the top of the country's governance and institutional structures. So this will be a big development in the years ahead. Like this isn't something that's just going to work itself out over like weeks or a quarter, in my opinion. This is something that'll take a bit longer, quarters, years type of situation. But this process has already started. Like the snowball is rolling down the hill. You're seeing the developments in credit ratings, its debt markets, its central banking policy tools, saying we're gearing up for that fight. Um, and as I said, because the U.S. and Mexico represent the largest bilateral trade pair in the world, like that's we talk about prizes, right? The interest income on the U.S. Treasuries, right,
Right.
being what all these stablecoin dollars are going for. That trade pair, right? That is a prize unto itself. So for something else to come in and displace it, you have to provide a bigger pie or like a bigger trophy to go after for private sector operators to chase than what already exists, which in my mind seems unlikely. Like that is a huge. It's hard to make a bigger prize than the biggest prizes that already exist, right? So I would say for the longer term, the most probable end game out of this is an alignment into the U.S. Treasury stablecoin dollar architecture that is emergent for Mexico, which is part of the theme of the like thinking about it, the entire Western Hemisphere starting to organize around this emergent framework, and then that all roots back to Bitcoin at the end of the day. But we'll just put that one aside. All right. So finally, just the end of the quarter close on the Japanese yen to bring it home, FX and sovereign debt gave a strong tell that major developments are in store in the foreign exchange and sovereign debt complex, and coming weeks, months, couple of quarters, but this is like right around the corner. It is what the charts are kind of flashing in my read. Um, the yen was unable to close the quarter below that 160 level, which has been a key support over the last couple of years. Um, that itself is an output of the imbalances in cross-border capital flows and excess leverage and the Japanese yen denominated borrowing that's now coming to an end, with the U.S., Japan, its trading partners who are aligned in this monetary transition, forcing the envelope, and pressing the issue. Um, so here, if you're looking at this in the big picture, we talked a lot about Mexico, but the Japanese yen, look to it as kind of your representation as the catalyst. But those allies, probably have the Japanese yen situation under wraps, or very likely. What to watch for is these developments in the yen triggering into a spillover in markets like Mexico. And that opens up a new theater in this kind of battle between the old and new world financial spheres that we're covering in Mind Print Hash. But this story likely plays out over several years, but we're opening up a very important new phase, is what it looks like to me. And steps look like what we're seeing is that integration of Mexico into the emerging stablecoin dollar system over, let's say several quarters or years, and away from that dying offshore dollar system. And if you look back in the history of ever since gaining its independence, it's been a tug of war between the old European worlds and the emergent kind of Western hemisphere, self-run, self-determining, um, kind of political and governance sphere. So huge developments in play. We're getting an early signal that Mexico has now entered the chat.